What's happening, everybody? All right, I'm going to be doing a monthly S&P 500 earnings and price update for you guys on this one. I'm going to try something a little bit different based on a suggestion I got on another post. I'm going to break this down. I'm going to do separate video posts, one specifically for just the broader S&P 500 with how things are looking. It's more tailored for like specifically TSP and 401k and whatever investors. If you're just looking at broader indexes, just going to cover that, or anybody who just wants to have a better, even if you invest in individual stocks or ETFs, whatever, and just want to have a better, bigger picture perspective of what's going on with the index, right? I'll do a separate video specifically for the different sectors and stock screeners for companies that reported earnings in the month of May. I think the latter half of May or whatever it was. I think I mentioned that it's the pace of earnings reports slowed down quite a bit, down into the dozen and a half every week for May. So I'm just going to cover those on this particular video. If you want to see what else has gone on over the last the earlier half of the quarter, refer back to my other videos that were previously posted for more of that information, right? But this one here, we're just going to cover S&P 500 broader index performance and also the bond yield curve. All right, that'll be it. And then I'll do a separate video for individual stocks and sector performance. Let's start with a summary view of how the index is doing as of the end of May. I have 474 of the 503 stock symbols accounted for now. It's saying stock symbols, not 500 companies, because 3 of those companies have two share classes each that are both in the index. Alphabet, News Source, News Corp, whatever they're called, News and News A are their stock symbols, and was one other one I always forget for some reason though. But there's 3 of them that have 2 share classes each. So we'll just say there's 503 symbols to account for, and so far we're looking really good. 19.95% earnings growth so far over the as far as year-over-year earnings performance between the current quarter and the same quarter last year. We are already up to 391 companies reporting positive earnings growth. That's good for 82.5% of the constituents in the index. This is very broad growth. This is a very bullish number here. All right. You're not going to see a recession happening with a very broad growth like this happening. This is a huge percent of the index participating in the earnings growth. So just for perspective here, last time we had somewhere around 82.5% was in third quarter of 2021. It was actually way up at almost 88%. And we got well over 40% earnings growth eventually on that. You see the percent positive tapered off from there, but the earnings growth over 12 months still accelerated before it started to slow down. So that's what we're kind of dealing with right now too. There was another one up here in 2018. Same thing here. We saw the breadth accelerate from 69.9 here. Well, you could even arguably say lower from all the way back here in 2016. But just consistent growth over 80% over here and through much of 2018. And look at what the 12-month performance did. It went from single digits into just barely double digits, and then it accelerated to the mid 20% range after we'd already been seeing plenty of 80+% growth before it slowed back down. So I would say there's a pretty good chance we're going to start seeing close to 20%, maybe even 25% earnings growth over the next year. At least it wouldn't surprise me, especially when the year-over-year figure is pushing 20% already now. Looking back to that comparison of previous. So these numbers were a little bit higher on the breadth, not by a lot, but they were. But we were getting over a good mid-20s, even low 30s quarter over quarter growth numbers there. And we got into the mid-20s. So I would imagine, I would expect that perhaps the 12-month figure might trail this a little bit, possibly. It could also outpace that eventually as well. But it's more of a trailing indicator. The 12-month performance, you would expect to trail this. So are we going to get 20%? Possibly. I would expect it to be somewhere in that neighborhood, we'll say. as far as the broader index performance is going to be concerned in terms of 12-month performance. And looking at the kind of earnings, the valuation snapshot here, our total market cap is at 72.351 trillion. I want to say we were in that same ballpark before. I don't remember exactly where we were at last time I reported this, but we were up in somewhere in that neck of the woods, I would say. Percent earnings growth expected over the next year is currently at 15.5%. That is definitely very bullish, very healthy. Now, how much of that's already baked into existing earnings versus how much has yet to come? That's another question mark. But so don't be surprised if you see some volatility and some tapering off in the prices over the next year, here and there. But the overall long-term directions would still be upward. So if you're not so too concerned about the short-term price behavior, which you should not be, unless you're going to be a day trader or swing trader or something, then it's most of you guys who are watching this should really be staying long-term. And right now, long-term look is definitely upward, not downward. Doesn't look like to me like you really have anything really to be concerned with as far as the earnings picture itself is concerned. Could be other factors to pay attention to that could affect that, but for the most part, remember, stock prices always fundamentally follow the earnings. And if the earnings are pointing up, then stock prices are also going to point up as well over time. Okay. So keep that in mind. Okay. My current swing out target is 72.30. So it's gone up a little bit. I think I was just a hair under 7,200 last time I did an update for you guys. I think 71.90, perhaps 72.10 at most. I don't remember the exact number, but it is up a little bit from last time. Index has been pricing up to about 7,200. So I do have concerns that we're getting a little on the inflated side with the prices. I don't think they should really be quite that high personally, based on what earnings are already reported yet. But we're in the ballpark now. Is it that big a concern? I don't think so, because if I recall, 7,600 down to 7,200 is only about a 4% drop. It's not much of a price bubble. It is a bubble, but it isn't much of one. It's not one that I would be overly concerned with. If we start getting like more closer to 10% above what is reasonable, then I would definitely say, hey, we got too much of a price bubble and we're really creating a huge risk of a correction back to the proper price level. Even though the long-term trend would be upward. I actually saw that in, I want to say 2017, 2018. I don't remember which one it was. It was one of those 2 years. There was a price bubble created that, where I saw the price climb a fair amount above what I thought, what my data here was suggesting it should have been worth. And it turned out I was right. Got so far up, we ended up having a 10, 12%, whatever it was, correction. And the price reverted right back down into that same neighborhood that I was expecting should have been normal. And then it followed the earnings from there. So are we going to be in that neighborhood, or the price, are the earnings actually going to catch up to the price eventually? The only time will tell. But we do have at least a small price bubble. I'm going to tell you that. Okay, so for those of you guys who want a more diversity and at least some kind of a conservative mix, now I always say on your retirement accounts, don't invest conservatively unless your account balance is already adequate for your retirement needs. Don't go just because you're retired does not mean that your balance is adequate for your needs either. Okay, so hey, I'm retired, or I'm getting ready to retire. What should I do? This is a very common question that gets asked on the TSP group, and I always say, forget about that. Ditch that logic that these financial advisors always like to preach, because they like to preach what you call a glide slope strategy. Their strategy is basically you go up, stronger growth, and then as you get closer to retirement, your account balance should already be closer at your needed level. And at that point, you don't need so much growth, and you can afford to, just let it smoothly go up a little bit at a slower rate. Maybe 4% perhaps. But then if you're withdrawing at a 4% rate, your balance isn't going to do anything during retirement either. So, and in reality though, if you're pulling 4 or 5% per year out of your account, but your account is growing by 10+%, then you're still going to see new record highs in your account balance, even while you were simultaneously withdrawing during retirement. So a lot of people in our group actually still focus particularly on stocks, but if that's not your cup of tea and you really want to be a little more risk averse, I always, first I say divide your account balance by 240. Do that before you do anything else. And if you want to be more conservative, that's fine, but I highly recommend make sure your account balance is adequate for your needs first. I can tell you from firsthand experience that you don't want to have your account fall into what I like to call a death spiral. A death spiral is basically where you get to a point where the percent growth that you're going to get out of your account from the performance is not enough to meet the needs that you're actually pulling from it annually. And the further the larger the disparity that exists between the two, the more quickly, the more rapidly your account balance is going to dwindle down to zero. You don't want to have that happen to you. Okay, so make sure your account balance is adequate first before you even think about going conservative. That would be my advice. Remember, I'm unpaid. I'm just a peer, just like you guys. I'm telling you what I'm going to do with my own account when I am ready to retire and live off it as well. Okay, so and I recommend you do the same. I posted already a previous video showing how the effects of this. Where if you make an adjustment, divide your account balance by 240, and then every time there's a down month, let's say the S&P 500 ends down from the previous month, recalculate what's your new balance, divide it by 240, and then adjust your withdrawal to that amount. All right, that's another can of worms here. If you want to go conservative though, first do that divide by 240 part, and then determine, is this amount adequate for my needs? If it's not adequate for your needs, then you are the last person who should be talking about investing conservatively, regardless of whether you're retired or not. That's my personal opinion. Again, there are other people can argue merits or whatever against it, but that is my own personal view, because I don't want to see you go into a death spiral. All right, get that. Now, if it is adequate for your needs and you need from your account, let's say your TSP, then I would say go with generally, Deb and I both tend to recommend an 80-20, 80% C fund and 20% G fund. 80% C fund would be the S&P 500 index. And then G fund would be just your government securities, your long-term bonds, what their growth rate is. It's always moving upward, but at a slower pace. That's the more simple and not quite so volatile way to manage your account. So if there are any drops, you won't see the larger volatility swings like you will see with S or I funds. You'll still see volatility, but it won't be quite as bad. It'll be a little easier to stomach. I have what you call the BEER ratio. This is bond equity earnings ratio is what it stands for. It's not just some made up thing. It's actually an investing term. And and this is something that you guys can follow if you guys are wanting some kind of a more market sensitive or plan there. All right, so we say 80-20. As much as 60, as little as 60-40 stocks versus bonds in general in the group. But the other way you can follow it is just follow this BEER ratio. Whatever it's suggesting, go ahead and go with whatever that is. But only if your account balance is adequate for your needs. Okay, just like a reminder, I need to hammer this home. I know I'm saying it multiple times, but I need you guys to understand. Do not invest conservatively if your account balance is not prepared adequately for your needs. Doesn't matter if you're in retirement or not. All right, so right now the BEER ratio is showing 80% stocks and 20% bonds. This is based on what, this 15.5% expected growth rate of the S&P 500 and the current 10-year bond yield of 4.27%. Okay, so that's what that's based on. Now, as bond yields go up and or this S&P 500 expected earnings growth rate drops, you will see this balance shift from 80-20 to say like 70-30 or 60-40 or whatever. As it might even get to where you have more in bonds than you do in stocks, or it could even get eventually to where everything's in bonds. But this is a good way for those of you guys who are risk averse and don't want to have more in stocks than you really want to, than you really need to have, and at least but you still need from your account, and have adequate account balances. This is what I would recommend doing. Okay, follow this BEER ratio, and then. I will update you at regular intervals every month, or when it's in the middle of the quarter when a whole bunch of companies are reporting updates. I actually do it weekly instead of monthly. All right, but that's only for like a 3 or 4 week period every quarter, something around there. All right, so 80% C fund, 20% G fund is what I recommend for those of you guys in TSP who are risk averse and have adequate TSP balances. And if you don't need your TSP at all, you can live without it. Then by all means, do whatever you want with your account. You can go even 100% G fund if you really don't need the money and you don't want to put it at risk, or if it's just your burn money account when you have other sources for your wealth management. All right, but if you need it all, follow that. divide by 240. That is 20 years worth of monthly withdrawals, in case you guys don't have questions about where'd you get that 240 from. Okay, 12 months every year times 20 years is 240. That's where it comes from. All right, let's look at bond yields now. I'm doing something a little bit different here. I got to do some tweaking with the conditional formatting, because right now the 30-year yields in some spots are showing inverted below something to the left. Basically what happens is if you see it colored in peach, that means something to the left, anything at all to the left of it has a higher yield than it. So let's go up to the beginning of January. And you'll see that a good chunk of the bond yield chart was actually inverted. So what you see are like the 1 month yield was at 3.72, and everything between the two. Well, actually, the 5-year was actually higher. It should not have. Well, let me double check. Yeah, this 5-year should not have been highlighted, and that's where I need to make some tweaks. Basically, what the conditional format is set up to do is compare this number to the max of everything of itself and everything to the left. And if it isn't the max itself, then it should be highlighted in peach. So everything to the left itself and everything to the left of it, like that. If anything at all to the left of it is higher, it should be colored in peach, and that indicates an inversion there. That's compared to something to the left of it. We want to see a stepladder bond yield curve chart, and I will show you in a second here what the chart currently looks like and illustrate it again. But we had a good chunk of these. How many of these? 7 or so? Yeah. 7 of the, how many different bond yields do we have? We got 14. So half of them were inverted at the beginning of the year to some degree, with to something to the left of it, basically. Something with a shorter length than it had a higher yield than it at some point at the beginning of the year. But as the year progressed, look at what happened here. We got down to like 4 back in March, or actually right around here. And that, that should have been an inversion. This one should not have been. 380, there's nothing to the left of it that was inverted, or that was higher. So there should have only been 3 right there on March 20. And, kind of went up a little bit again here and then back down to no more than 3. We are again at 3 here. These are definitely legit inversions, because these 3-month yields are definitely lower than something to the side of it. But we do see May 20th and 21st, just a couple weeks ago, we actually had a situation where we did not have any inversions at all anywhere in the bond yield chart. It was flat for the first, for the shortest 4 maturity lengths. And then it went up, 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 and up and up, all the way up to the 30-year. So definitely legit no inversions there. But now this one here, there should have been some inverting. Yeah, there should have been, because the 1 month yield jumped back up from 365 to 372 on May 21st. So it does indicate in the short term a better chance that the Fed will keep the Fed funds rate unchanged. Their next meeting is coming up in mid-June. It'll be a week from Tuesday, this coming Tuesday. Tuesday and Wednesdays when they have the meeting, and then Wednesday afternoon they announce what they're going to do with the Fed funds rate. They'll either, they're going to keep it the same as what the bond market seems to be predicting right now. In the future, there are expectations that it'll go up because of the current inflation rate. But in the very short term, the 1 month yield is at least hinting at no move at all. But as we get close to the end of next week or very beginning of the week of the FOMC meeting, there's a better chance we'll see some kind of movement of the 1 month yield before they actually make a decision. If it starts climbing up to closer to 4% by then I would say there's a much stronger chance that you're going to see the Fed announce a rate increase to the 375 to 4 range at that meeting. I don't really anticipate them going down to from 3.5, 375 down to 325, 350. But it's possible. And if they do, then you'll see this 1 month bond yield start dropping closer to 3.5 before they actually make an announcement. But I don't really anticipate that happening, but we'll see. We have a new Fed chief and Fed chair at the helm now, so things could change. But I don't really anticipate it personally, but we'll see. All right, this is what the bond yield curve looks like visually. Again, a bullish bond yield curve goes higher and higher as you go from left to right, kind of like that. So we do have just a slight bit of inverting on this very far on the short end of the curve, but then it just goes up the rest of the way and it looks good. This is bullish. Again, we like this. Now there is but like I said, these longer term bond yields are getting are hanging around 5% though, which does increase the likelihood we will see a increased a higher Fed funds rate at some point in the future. Maybe not this coming, not this this month, but at some point in the future, maybe later this year, there probably will be one forthcoming if we don't see one this month. Lastly, I'm going to cover constituent changes. There is one that is coming in June. I haven't put it in the data yet because it's not effective until June 1st. And the data I'm reporting to you today is only through the end of May. I'm not doing it, even though it's I think the 5th of June today. Even though there have been some new earnings updates, I'm not doing those until after this presentation first. And so that will be forthcoming though. Basically FedEx spun off FedEx Freight. And both FedEx, what was left of FedEx and the new FedEx Freight company are both large enough to stay in the S&P 500. And because of that, EPM Systems, which was at near the bottom of the index's market cap rank, they got bumped out of the index and I think pushed into the S&P's S&P 400 or 600, whichever it was. I can't remember. I didn't pay that close attention to it. What usually does happen when these companies get bumped out of the S&P 500, they get pushed down into the S&P 400 mid-cap index, or if they've really shrunk that much, they could even drop as far down, drop into the S&P 600 small-cap index. But generally, the movement is between the S&P 400 and the S&P 500. Companies get promoted into the 500 and get demoted into the 400. The $8.2 billion market cap is where that trigger line is, basically between what can stay in the S&P 500 versus what can't stay. But in this case, the spun off result, I have not taken a look yet at what FedEx Freight's market cap is, but obviously it's big enough to merit staying in the index, as well as FedEx still as too. So that'll be getting reported more, maybe a little more detail on next month at the end of month and end of quarter report at the end of June. But just so you know, that is forthcoming. It's been kind of a slow first half of the year with constituent changes. We have 7 that have been completed so far. Yeah, and then this is number 8. It's in the past, I tended to see somewhere roughly around 24 constituent changes over the course of any given calendar year, give or take some. So this is on the softer side of that. Not as much movement, not as much M&A activity, and doesn't seem like there's much market cap changing going on either, is what we've seen in the past. Okay, I didn't show the graphic, but I went ahead and took a quick look, and it turned out there were 33 new updates to the earnings data since my last update, and they amounted for about an 18, just a little bit less than 20-point increase in the value. So yeah, I was right. I think 72.30, I think is what I had said was what the current value of the index is at right now. That's just without any earnings, forward earnings expectations flavored in with it. If we just had flat growth, no growth or decline in earnings expected at all over the next year, that's where I think the index should be. Or no, actually, it's half of next year's expected value. My bad, I forgot about that. Next quarter, over the month of June, it is going to be very slow. I only have 9 companies for the current week to look at, 6 next week, and 3 in the week of 15 to 19 June, and then 9 on 22 to 26 June. And that'll be the end of the quarter. We do have 2 companies reporting the week of 29 June to 3 July, but those are tentatively scheduled for the 1st and 2nd of July. So those might technically get factored into the third quarter update, the first of the third quarter updates instead of the end of the second quarter. So yeah, very slow progress. What's that? 15, 18, 27. Yeah, less than 30 companies left. Yeah, there are 29 actually. If you think 503 companies, and we got 474 that are already accounted for. So yeah, less than 30 to go. That's all I'm going to cover on next month's update. Or since it is that slow, I'm not going to do another update until the end of June. And at that point, I'll also do kind of cover it. It'll also be the end of quarter, which is kind of just same basic data there. It's just a little bit of compartmentalized stuff added with it, perhaps. All right, that's all I got on this one. I will do another video for you guys who want to know more about individual company picks or sector, industry, whatever type of ETFs. We'll cover that a little bit. There are a little more between ETFs and mutual funds, by the way. I'll talk about that in the other video. All right, that's all I got. Appreciate you watching. Thanks.